Currently, we expect growth to remain more than decent within the quarter to come. We don't think that growth is the issue at all. We've learned to sail through an environment of good yet uneven growth, with the US roaring, the Eurozone being above potential yet slowing down across the year, and the emerging market space slowing down, being below potential, but now giving early signs of stabilization. So we don't think that the issue is growth. We think that the issue is inflation. We've had a long period of good growth, which will translate eventually into higher inflation. We don't think that people are prepared enough for this type of period, and our indicators are clearly pointing to higher inflation than expected, coming from the oil situation and the growth rate of wages across the world, especially in the US. Currently, we see two opportunities and one risk. Opportunity number one is equities. We've been very positive about equities over the past quarter. Not so much for emerging equities, and that basically what is changing for this quarter. We used to be very negative, and now we are becoming neutral up to positive because of the pricing of emerging equities these days and the better macro momentum. That was the first opportunity. The second opportunity is, of course, given that we expect more inflation, we want to be invested in this story, and we want to do that using commodities first and inflation break-evens, because both assets should be able to offer diversified exposure to inflation, and inflation break-evens have been lagging the evolution of oil prices these days. The risk that we're seeing is, of course, that with higher inflation, usually you see higher rates, and higher rates imply that for a multi-asset fund, a big risk given the natural allocation of multi-asset to government bonds, and we remain quite negative on government bonds. Consistently with what I just said, we have two overweights and one strong underweight. First overweight is for equities. We have a global overweight for equities. We have still a preference for US equities for the time being, but as I was saying, our vision of emerging equities is currently changing. Second overweight is for assets that are a natural hedge against inflation, such as commodities on one hand and inflation break-evens on the other hand. And the biggest risk that we're seeing, the strongest underweight that we have, is actually for government bonds, for which we have not a direct underweight, but an optional protection against a global rise in yields.